So have you ever looked at a stock to see the price go up, but don't know where to buy? And on top of that, do you find yourself asking, where do I sell it? Hi everyone, and welcome to the Beginner Trader series. Today's topic is all the basics. After this video, you should have all the day trading basics needed for short-term and long-term trading. To start, we'll need some terminology. So what is investing and what is day trading? Investing is long-term buying and holding of equity. Day trading is short-term buying and selling of positions based on strategy and criteria. Most of the time, traders use platforms. A platform is an application used to buy and sell positions. Examples include Thinkorswim and Trader Workstation. You might see these applications in people's phones and their laptops, but I would recommend staying away from trading on the phone. These platforms are connected to brokerages, so Thinkorswim is connected to TD Ameritrade. Trader Workstation is connected to Interactive Brokers. Simply put, a brokerage just routes people to fulfill trades. Now when you're in the platform, you will be able to input a ticker or symbol to trade. A ticker or symbol is the unique combination of characters of the things you are trying to trade. Some examples include Apple, which has the ticker symbol AAPL. Amazon has AMZN. Microsoft has MSFT. Some non-obvious ones might include the S&P 500, which has the ticker symbol SPX, and the E-mini S&P 500 futures contract, which has the ticker symbol /ES. So you're on a platform and you're executing trades. You might notice if you try to buy and sell multiple times, the brokerage will flag you as a pattern day trader. If you are flagged as a pattern day trader, it means you are someone who executed 4 or more round-trip trades in a 5-day period. An example of a round-trip trade would be if you just opened and closed a position. Don't worry, you didn't do anything wrong, but the bad thing is they will stop your trading if you do not have a $25,000 balance or higher in your account. That's why knowing what to trade is really important. In this series, we'll be focusing on the E-mini S&P 500 futures contract, since these are not limited by the pattern day trader rule, and you could start trading with however much money you want. Also, as beginner traders, I hope you would take my advice that you should focus on one ticker and one ticker only for the time being. This will help you learn so much more and faster, as other tickers might act differently and you'll be tempted to continually change your strategy and what you like to see. So how do traders actually make money? Well, currently the E-mini contracts are worth $50 per $1 of underlying movement. What that means is the contract is worth $0 when bought. But let's say that the S&P 500 is currently worth around $3,770. When the S&P 500 moves $1 to $3,771, then the contract is now worth $50. Then when the S&P 500 reaches $3,772, then the contract is now worth $100, and so on and so forth. So let's say we sell the contract when the S&P 500 reaches $3,775. So since the S&P 500 has moved $5, that would make our contract worth $250 at the time that we sell it. That would make our profit/loss, or our P&L, $250. The best thing about this is that it's scalable. Whether that's changing your position size or having a strategy that helps you hold longer, there are a lot of ways to make more as your account size grows. Note we can do the opposite trade if we believe the price is going down by shorting it. So when the price goes from $3,770 to $3,765, this would give us the same profit/loss of $250. In order to find these $5 or more moves, we're going to need to learn how to read charts. A chart is basically a visual representation of historical price movement. There are multiple types of charts. To name a few, there are candlesticks, bars, and tick charts, but the list goes on. But in this series, we'll be mainly focusing on candlesticks. So what is a candlestick? It's basically one single timed point of price movement in a chart. So in this example, each candlestick is worth 5 minutes worth of data. Therefore, this chart has 10 minutes worth of historical data. Now you'll notice that these candles are 2 different colors. One's a green candlestick and one's a red candlestick. All candlesticks come with 4 attributes: the open, high, low, and close. So looking at the chart we have, we can see that the green candlestick opened at $3,707.25. Then somewhere along the 5 minutes, it went down to $3,704.50, and then made its way all the way up to $3,718.75, where at the end of the 5 minutes, the candlestick closed when the price was $3,716, which then started the 5-minute timer for our next candle, the red one. Notice that it opened where the last candle closed. Then somewhere along the 5 minutes, it went all the way up to $3,721.25, and then came all the way down to $3,700.25, and then made its way back up to close at $3,705.50 at the end of the 5-minute period. Then the cycle repeats for the next candle, and so on. A chart could have hundreds of candles, but here we only have 2 for simplicity. But one candle is allotted the same amount of time, 5 minutes. If these candles represented 1 hour, then this chart would simply be 2 hours of data. If we had 5 candles, 5 hours, and so on. You might already notice what gives the candlesticks their color. For the green candlesticks, it's when the close price is higher than the open price. For the red candlesticks, it's when the close price is lower than the open price. Note that a $5 movement happened within both 5-minute candles, and that would give us $250 on the way up and $250 on the way down, giving us 500 potential dollars. If you found this video interesting or useful, please give this video a like to support the channel and future videos. Subscribe to the channel to keep up to date on the newest videos and analysis I will upload. See you in the next one.